Hello investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And as I've been mentioning over the past 3 weeks, we are stuck in a trading channel. We have this green dotted line right around 330 acting as support. I have this line up top here as a gap fill, resistance up there around 340.54, and we are oscillating in the middle of that range. Now today we closed with a bearish harami. I'll magnify that for you so you can see that. A bearish harami is ranked as one of the most bearish candles. It's right up there with the bearish engulfing and the shooting star. Here's a shooting star. You see those, very bearish. And so we now have the possibility of a drop next week because we failed to close over and stay over that 20-period moving average. So next week I think we are going to drop lower and go right back into testing this support level here. You see, so we are putting a downside target of 331.43 for next week. I have all these lines I'm leaving in place so you can see how the price action again has been oscillating in that trading range. So again, that downside target at 331.43. You can see that the CCI crossed over the momentum line and now it's hinging sideways and could very well drop right back down below that zero line. So that's DIA. If we look at IWM, this is one that actually hit the upside target from back here at 177.02, but we do have a red candle right at resistance. Now that that target is hit, I'll remove that line, and we have this resistance up at the top right here. We have support, so these green dotted lines are what I left to display the trading range or trading channel that we are stuck in with IWM. So for next week, look at the CCI. You can see we're already hinging down from an extremely overbought condition, and the stochastic is starting to hinge after it too hit an overbought condition. So I'm putting this downside target down, right back down to the moving average. That downside target right there is 173.89. Now let's move on to the Qs. Out of all the major markets, the Qs are the strongest. We've got AI fever. This is very similar to what we saw in the dot-com days in late 1990s, 1999. Anything that had a dot-com at the end of the company name was a billion-dollar company. And people got caught up in that rage right up until Alan Greenspan, who was the Fed chairman at the time, used the words irrational exuberance. I'm not going to take those words from Alan Greenspan, but you have to watch what happens in the AI craze. I think AI has extremely good potential, but you have to be careful. It's a double-edged sword. There is a craze right now, and so you have to make sure that you don't buy into conditions that are extremely overbought unless you are using risk management technique and trailing stops. That's the only thing that I could tell you about that. Now we have breached this 333.5 level of resistance. However, if you look down below, you'll see we do not have a follow through higher volume. We have a lower volume on this spinning top candle here. Wide divergence from the moving average. We have the CCI hinging lower. The stochastic is about to cross. We still have gaps below the market. And so I'm not moving that downside target at 321. I'm keeping that in place because if you look at what we have on the monthly chart here, you can see that the monthly chart is showing the candle here right at that resistance, but we have a drop in volume with this super wide divergence between the K and the D on the monthly chart. So that is trouble if you are planning on just buying and holding without any kind of protective stops. That could be a very dangerous condition for you on the Qs. Now going back to the daily chart on this, you can see one other thing that I want to point out is that we have this gap here, very slight gap, has filled. And so 80% of the time gaps fill, but then 80% of the time after gaps fill, prices generally reverse. So keep that in mind as you are taking your positions in the Qs. Now SPY, take a look at that. We have another red candle at a resistance level. Again, we have a very slight but still open gap up here on SPY. That gap would be filled at 421.22. There is a chance that that gap could fill, but as soon as that gap fills, I think there's a high probability that we will drop from this point. So what I'm going to do is I'm going to redraw the lines now that these targets have been hit, because you can see here we have that target from 2 weeks ago has hit. And so I'm erasing all these lines and I'm going to redraw using the dotted lines that I have been using before. So we have this gap here, right there, and we're very, very close to it. Again, that gap would be filled right there at 421.22. And in the meantime, I think next week, with all the pressure that we have on us as a nation with regard to the debt ceiling debate, I think that that could fail pretty miserably if they don't come to any conclusions here next week. You have to understand that the following Monday is going to be Memorial Day, and Congress takes off for that. So if they don't get anything done from next Monday to next Friday, then we are absolutely at risk of defaulting. And that's something that Janet Yellen has been screaming about lately, because she has $600 billion of bonds that she's trying to get out, and she can't do that until they pass the bill and raise the debt ceiling. You see, so this is going to be something that could lead to a global catastrophe. I think they will come to some sort of conclusion. The markets may even try to rally on that, as crazy as that sounds, but I'm going to show you some geopolitical stuff that is going to maybe put pause on that extreme rally as we look at the condition of the world around us. Now, the downside target for SPY, I'm putting it a roll reversal from that high. So I'm going lower on SPY at 414.47. Let's talk about the VIX. The VIX is now pivoting, but it's not just pivoting. We have a bullish harami right there. That bullish harami is, again, one of the most bullish candles that you're going to find. We had a bullish harami back here. See how that worked out? Little green body candle inside the red body. And we rallied quite nicely after that bullish harami showed up. Right? So I'm keeping that upside target on the VIX set at 2137. And as I mentioned last week, I'm starting to look more and more at the VIX, the one-day VIX, which is right there. Now, I started talking about higher highs and higher lows. This is an oscillator, so you can't apply the same trend technique as you would a stock or an index or a commodity of some sort. We are seeing higher lows here on these pivot points. You see? So here's a high that was higher than the previous high on this candle. It went into a big green candle here on a higher high. Now what we're seeing are higher lows with higher highs. So we have a slightly higher low, and I think that the one-day VIX is going to start to storm up. And if you look down below, you'll see something pretty interesting, is that we are heading for this zero line. That would be the first time ever since the one-day VIX has been created that we could have a momentum cross. And if it does cross, I'm going to be applying the same rules that I apply for any other stock, where if the momentum line or the zero line crosses, we can generally count on 2 to 4 days of a move in the direction of the cross. So if it crosses above that, we could get 2 to 4 more days of higher volatility on the one-day VIX and even on the 30-day VIX. Now let's talk a little bit about the geopolitical news. We have a lot going on here. This is coming from the New York Federal Reserve, and what they put out is that the odds of us going into a recession sometime over the 12 months, I have to laugh at that. They say it's extremely high. It's a 40-year high. Folks, in my opinion, they're not going to be putting out, sounding the trumpets that we're in a recession. I believe we're in a recession right now. They're going to hold off as long as they possibly can from announcing that. They're going to draw all attention away from it. But the fact is, we are in a recession right now. They just haven't labeled it as such. And as a result of the poor economic state that we are in, you see here, this came out through Credit and Debit magazine on their website. Household debt has hit a record 17 trillion last quarter as inflation squeezes Americans. People are using their credit cards to pay bills. Not a good thing, because what usually follows there is you generally get a slew of bankruptcies. You'll see the court filings start to stack up in bankruptcy court. You got to keep an eye on that. That is not a good thing for the economy, obviously. And this is not any better. This is existing home sales, which is considered to be a leading economic indicator, has continued to trend lower. And that is what we're looking at right here with this line right here. This blue line is existing home sales year over year. And we can see that we're in the red here. We're dropping quite rapidly. And another reason for that, obviously, is because there is a shortage of inventory in the real estate market, because people who own a home, let's say that you own a home and you had the opportunity to lock in a mortgage rate below 3%. Well, you don't really want to roll out of that mortgage rate so quickly and get into a much higher rate down the road and have it be more expensive for you to live in another home. So people are holding on to their homes and not selling them. And therefore, you could ask any realtor, the inventories are drying up. We had a couple of our realtors, I'll mention first name only, Dan and Zen, who are two of our VIP members who are in California. That's telling us that when an open house or a house becomes available, they do an open house. It's like, like a rock concert. People have to line up in the schoolyard to park their cars because the inventory is so light. And so that's going to be very interesting how that plays out, because it's a combination of people just not having the money to buy a home, or people that just don't want to get rid of the homes because they want to roll into a higher mortgage rate. You see? Now, this is going back into the banking sector. I want to tell you that we are in a crisis still. This is KRE. This is the regional bank ETF. And this just happened today. This was a collapse of the price action in the regional bank ETF here. And I think this is going to keep going lower. And I keep telling people, I keep warning them that, they're distracting us with this debt ceiling debate. But meanwhile, the banks are still in trouble. There are many, many insolvent banks that are out there. There's almost 50% of the regional banks out there. According to 2 weeks ago, I put out the alert on that the insolvency is a problem. And I do believe that that's going to continue to rage forward. Now, with regard to economic outlook, you have to understand that our southern border is still open. Now, I'm not making this to be too political. I know the comment page is going to light up on this one, but our open border is wide open. This is going to be a problem with drug smuggling, with fentanyl, with many other things that are going to affect our economy. But you have to understand that these folks are being bused to different areas in the country. There is a crisis in New York where the political leaders are getting backlash from parents who are outraged that their kids are going to school while there's homeless immigrants coming in and living in the schools. And in New York, they're shutting down some hotels because of that as well. Chicago's in trouble. It's just the fact that this is going to drain our economy. Here we are, we can't even pass a debt ceiling bill, yet we're still sending money to Ukraine, and we're funding people through these social programs here, which is draining taxpayers. So remember what I said before, Americans are already being squeezed, and it's only going to get worse from here as government officials, not just federal representatives, but local and city, are taxing people to the hilt. And eventually there's going to be a breaking point, and I don't even want to go where I think that could go, because it's totally off topic from the market. But you have to understand that we are not in a good position right now. So if you're looking at the markets and you're saying, okay, well, I think volatility is just going to lay flat, I would say think again on that, because if you go back to the VIX and you look at the times when we were at market tops, extreme market tops, I mean, folks, we're down below 17 on the VIX. There is no way we're going to go into a bull market with the VIX hovering below 20 or even below 30. In my career, over 40 years, that has never happened. And I have to say that I don't see a bull market down the road in any case whatsoever. So stay tuned to the weekly market reports and the midweek report. I'll be giving you some updates next Wednesday as well with regard to the market as we progress through the week and see where this debt ceiling debate is leading us. But make sure you're keeping your stops in place, make sure you're managing risk, and make sure you have a good weekend. I'll talk to you on the next alert. So long. There's no more damaging formula than to mix emotions with money. Listen, we're made up of emotions. We have fear, we have stress. The trading checklist helps take that all away. And now, wow, take a deep breath, relax, and enjoy the ride. You might be completely foreign to technical analysis. You may not even know what a bullish engulfing candle is or a shooting star. That does not matter. The great thing about what I'm showing you right now is I'm taking 40 years of experience here and I'm breaking it down to 7 points that you can follow through a trading checklist. Look at any stock, any ticker symbol using the 7-point checklist that I have and determine who is in control of that price action. I'm AJ Monte and this is my 7-point trading checklist.